Hello, my name is Carlos McCord, CPA, and today I'm going to go over one of the things that I like to talk about as far as investing during a recession. The particular type of stocks that you need to be looking out for during this time. As we know, the market is very overvalued and there's a lot of great companies, but the price is just too high right now. So we want to look at some businesses where the value might hold better during a recession just because of the nature of the business and of the industry that they participate in. So we're going to talk about defensive stocks. Now, one thing about a recession, a lot of people have a lot of fear during a recession. It's part of the reason why we have these recessions. There's a lot of euphoria and hype that drives the market up. It drives it to an overvalued state. We end up in a bubble. Whatever disruption there is that drives that bubble or that euphoria, sometimes that dies down or sometimes it's all hype, whatever it is. Then as the market starts to slide, that's when the fear sets in. And I don't believe we should fear, but we should be prepared and take advantage of the great opportunities that the market is going to give us. So with that said, let's dive right into it. Defensive stocks. We want to talk about defensive stocks and why during a recession or at all times, as I'll get into later, you want to always make sure you have some of these stocks in your portfolio. So what are defensive stocks? These are businesses that thrive during economic recessions. Why? These organizations offer vital products and services. So during a recession, a lot of businesses and a lot of consumers, we like to cut our spending to take care of ourselves, to take care of the essentials. Defensive stocks provide those essentials. So these are your food companies, your beverage businesses, utilities, healthcare. If you were to think about it, people are still going to need those things. Like, we may not be able to go spending on a fancy vacation, but of course we're going to pay our water bill. Of course, we're going to pay our, electricity bill. And of course, we're going to feed ourselves. So those are the defensive stocks that we want to focus on, or the types of stocks we want to focus on during a recession. So these can safeguard your investment portfolio. These are particularly safer investments because they're stable, and they become popular during this time because they don't give you the super high growth potential that a lot of the hype stocks give you. However, over the long term, these stocks actually have similar gains to those types of businesses. So let's get more into it. So when do people consider these stocks? We're looking at the economic cycle: expansion, peak, contraction, the trough. And that repeats over and over and over. Of course, we have the hype and euphoria that we talked about in the peak. But when we start to hit this stage here, this is when people start paying more attention to the defensive stocks. However, a smart investor is going to have some of these defensive stocks in their portfolio at all times because of the benefits that it gives. And we'll talk about that a little bit later. So here are the characteristics of a defensive stock. Number one, strong brand. These are types of companies, for the most part, you and I, we know who these companies are. There's not going to be some company we never heard of, unless we're talking about some obscure utility business that you don't know about. But for the most part, we're talking about brands that you and I are familiar with and that we use and that we know. They dominate their market. They provide these stable earnings because for whatever reason, they've been the leader in that space, whether it's distribution that they've mastered, whether it's just having a physical footprint everywhere, similar to Walmart. In distribution, you're talking about Colgate, Palmolive, or some of these larger companies that are in every store. It's because the distribution channels that they dominate. So they're dominant in their market for some reason. They have a competitive advantage. It's hard for newcomers to take their spot. If you were to think about some of these businesses, they're so large brands. Again, they're dominating their market. Even if the barriers to entry are not as high, it may be difficult to take them over just because they're so dominant and they're so ingrained with their customers. Here's what I love: consistent dividends. Because they're dominant and they have a competitive advantage, they have excess earnings over their capital needs. So what do they do with those earnings? They can't reinvest it into the market and get high returns because they're so large. They start paying the dividends. And this is a key factor in why these stocks are important at all times, not just during a recession. Stable earnings in any economy, as we discussed. Long-term gains with lower risk. So These stocks, and well, number 7, low volatility. So we're going to talk about these two in kind of one setting. So these stocks have lower volatility, which means they have lower risk. Now, yes, as the market is shooting up, these stocks are not going to rise as fast. However, they're still paying you a dividend. So you have that opportunity to reinvest and experience compound growth in that way as well. However, when the market comes down, these stocks don't come down as much because they're stable and they have these earnings that aren't volatile because of a recession. So let's look into another example of that real quick. Defensive stocks. Look at the industries that they are in. Consumer staples that we talked about. Consumer staples is the products that we need. We need our hygiene products. We need our shampoo. We need our lotions. We need our soaps, our detergents. We need these things no matter what happens. We need these things. We're not talking about consumer discretionary, where it's up to my discretion to use these things because I may not really need them, so I can cut back at any time. These are consumer staples. We must have these things in our lives to live the life of convenience or comfortability that we like. So healthcare, of course, we need our medicines. I might cut back on some spending, but if I have prescriptions or if I need a surgery of some sort, Americans find a way to keep spending in healthcare and consumer staples. Utilities. Of course, like I mentioned before, it's one of those things that we're going to find a way to make sure our lights stay on even during a recession. And just comparison with tech, I wanted to look at the betas. Consumer staples, they have a beta of 0.5 to 0.6. And just to explain the betas, when you look at a beta, the beta of a stock or a portfolio lets you know what the volatility of that stock or portfolio is compared to the overall market. So a beta of 1 means if the market goes up 1, that stock or portfolio goes up 1. Of a beta of 0.5, if the market goes up 1, that stock only goes up half, 0.5. Conversely, if the market goes down 1, that same stock with the beta of 0.5 only goes down 0.5. So it doesn't give you the fast gains, but it also protects your portfolio when it comes down. So it's all about risk. You have to assume, all investing assumes risk, but you want to make sure your profile is designed to protect you, not just designed to find the hottest stock and give you the greatest gains in this year or in the short-term period, where we invest for the long term. And in the long term, we want to be protected, not just having these high risers, because those high risers also fall the fastest. So you got to remember that. So with that said, consumer staples, we have a beta of 0.5 to 0.6, healthcare 0.8 to 1, utilities 0.6 to 0.7. So all of these stocks have a beta of healthcare 1 or typically lower than that. So you're talking about a typical beta that's lower than 1. Of course, tech companies are typically higher than 1. I believe the average is about 1.5 right now. There's some right now that are at over 2. If you were to look at it, some stocks, even that I've reviewed on this channel, over 2.3, I think some of these were for these tech companies, which lets you know they're super, super volatile. And if a recession hits, these stocks are likely to fall down just as fast as they rose up. So you have to be careful. So with that being said, again, do not avoid stocks that have a beta lower than 1. You might see, well, these other companies are going to grow faster. Remember what I'm saying. The ones that grow fast fall fast, and you want to buy and hold for a long time. The reason why these stocks give you great gains that are comparable to some of these high rises over a long period of time, the high rises go up fast in any 1 or 2 year period, but they also fall down as the earnings start to slow and don't really catch up to that peak price that it gets to. Whereas some of these other stocks, as the stocks are continuing to grow with the earnings, the steady earnings year after year, the stock climbs year after year with lower volatility, so lower downside. Over the long term, these stocks give you similar returns to the hype stocks when you look at 10 years down the road. So let's look at some of the more popular defensive stocks that we know about. Again, most of these brands you and I are definitely going to know about. So we have Walmart. Walmart and Costco are not necessarily in those industries as far as consumer staples, but what do they sell? They sell a lot of consumer staples. And this is why these are considered some defensive stocks. Colgate Palmolive, you see their products in every store that you go to. You see them in Dollar Tree, you see them in Walmart, you see them at the grocery stores, you see them at Target, you see them everywhere. You see them at Costco. You see these stores everywhere because they dominate the distribution channels. This is why this is a very popular, very strong defensive stock, and just a strong stock overall. Some of these are just great businesses to own, and not just to cycle into during a recession, but just to have in your portfolio. Unilever, same thing. We want our products, our hygiene products in our homes, no matter what. Coca-Cola, if you look at their earnings, no matter what's going on with the interest rate, no matter what's going on with wars or whatever geopolitical issues there are, they are going to make their money. Procter & Gamble, similar to Unilever, Johnson & Johnson, Kroger, again, grocery store. And they also sell a lot of the consumer staple products, but just food and beverages. We need to eat and drink during a recession. We have some utility stocks, Dominion Energy and the Southern Company. And then we have Lowe's. Lowe's is not necessarily one that fits into these categories. However, during recessions, when people need renovations, typically they do them themselves. They do the repairs themselves. So during a recession, this is a company that's going to hold on to their earnings and might even continue to increase them. We have Eli Lilly. We have a healthcare company, AbbVie, and Bristol Myers. Now, I'm not saying that these are stocks that you should invest in. I'm just saying when it comes to defensive stocks, these are the types of stocks and brands that we are talking about. So keep this in your mind, do some research and figure out whether you need to do some rotation in your portfolio. If you don't have any defensive stocks in your portfolio, you definitely need to start thinking about them, not just for the recession, but for the rest of your investment journey, because these dividends are very important to the gains in most people's portfolio. They're definitely significant to the gains of the S&P 500 since 1960. So you definitely want to have dividends and dividend growth in your portfolio. Even if if you have confidence in yourself and you're really good at picking those tech stocks, if you picked Nvidia when it was $1 or whatever it is, I understand. But don't be overconfident to think you don't need these stable traditional companies in your portfolio. Everyone needs them. So I hope you enjoyed this video. Stay tuned for the next. Hope to see you next time.